Do you think that you can get better returns than 90% out of all hedge fund managers out there? If your answer is no, think again, because today we're talking about a product that has it all. The trifecta, if you wish, of smart investing: diversification, low cost, and ease of use. For quite some time, people were playing with this idea that stocks could be grouped together into a basket, placed onto the exchange, and traded as a single unit. And this idea became a reality in Canada in 1990, which led to the revival of this idea into the US. And on 22nd of January 1993, State Street Global Advisors created the Standard & Poor's Depository Receipt, also known as SPY or SPDR. Today we know this as the first exchange-traded fund that tracks the S&P 500 index, and it's still the largest in assets under management. In order to continue, let's first see what ETFs are. It's right there in the name. Exchange-traded fund. Fund that is traded on the exchange. Essentially that means, if we continue the example with the index tracking ETFs, that instead of buying the individual stocks in order to get exposure, you can buy the shares of the fund, and this will give you the exposure to the underlying assets in the fund. Imagine this as a box, for example. If you put the shares from an index into a box, then close the box, divide the box into different small pieces, shares of the box, and trade those onto the exchange. So investors can buy the shares of the box instead of the shares of each individual assets within the box. In the early years, ETFs struggled to get popular because Wall Street didn't like them at all. And from their perspective, what it is to like about this new product? It was low cost, there was no minimum investment amount, and on top of that, it was impossible for them to charge management fees because it was run passively. No management fees for them means more money into the investor's pocket and less in theirs. No wonder that this wasn't their favorite product. According to the data, by 1996, assets under management in ETFs were only $2.4 billion, and in 1997, the total number of ETFs were just about 19. However, things took off in late 90s and early 2000, mainly because of the growing awareness of the superiority of index tracking over stock picking, and because of the rapid advancement in the internet technology. We saw the first gold ETF in 2004 and the first actively managed ETF in 2008. This report shows very well how ETFs rapidly grew in popularity. Between 2009 and 2019, ETFs became second in terms of technology adoption rates by society, higher result than social media, and only surpassed by the adoption of smartphones. Investing in ETFs made so much sense for all kinds of investors, from beginners to the most experienced ones, that Warren Buffett made his famous bet in 2007. He bet $1 million that a simple S&P 500 tracker would outperform a basket of at least 5 actively managed funds over the period of 10 years. The bet started in January 2008 and completed in December 2017, and the results are astonishing. The active managers resulted in average yearly return of 2.2%, and the S&P tracker resulted in 7.1%. To comprehend how significantly different those are, 2.2% per year from the period of 10 years results in total gain of 24%, whereas 7.1% for the S&P 500 per year for the period of 10 years will result in gain of 99%. Which essentially means that if you had put $1,000 at the beginning of the bet, with the S&P tracker you would have doubled your money, whereas if you've chosen the strategy of the stock pickers, you would have only $1,240 after the 10-year period. It almost doesn't make sense, right? It was very hard for me to believe, at least. Imagine some of the smartest people in the world, and yes, indeed, some of the smartest people in the world are actually working in finance. So those people putting their heads together towards the single idea, the single goal of beating the market, and yet over the long run failing around 90% of the time. Anyway, we're digressing here. So after 2017, ETFs exploded even more in popularity, and we started seeing different variations of the plain vanilla ETF that we know from the past. Some of the most trendy ones are leveraged ETFs and inversed ETFs. Inversed ETFs are exchange-traded funds that use derivatives to achieve opposite movement of the price of the ETF compared to the price of the underlying assets. So essentially, both prices move in the opposite directions. If the value of the underlying assets start declining, the value of the ETF will start growing. The selling point of those is essentially that it gives opportunity to people to gain returns from the declining price of underperforming assets. It's essentially like short selling. The other trendy variation is leveraged ETFs, and those are using debt and derivatives in order to magnify the returns from the underlying assets. If, for example, plain vanilla simple ETF will give you 1% rise in value for every 1% rise in value of the underlying asset, the leveraged ETF will give you 2% for every 1% or even 3% for every 1%. The danger comes because those forces are working in both directions. So they can magnify your gains, but they can magnify your losses as well. All those different variations of the plain vanilla ETF are opposing the main idea of why ETFs were created in the first place. They were supposed to be easy to use and less risky investments. Essentially, instead of trying to beat the market, you buy the market. And don't take it from me, take it from Warren Buffett. If plain vanilla ETFs are good enough for him, are certainly good enough for my investments as well. With all that said, let's move to the good part. I'm going to show you how you can actually invest in ETFs and what are the things that you need to be mindful about. Okay, let's now have a look how you can buy yourself some ETFs. Now I'm based in the UK and I mainly use Vanguard and Investing 212. Actually, I do have my stocks and shares ISA with Investing 212, and today I'm going to show you how to navigate the Vanguard website and the Investing 212 website. If you're based in the United States, you would ideally go to investor.vanguard.com, and I'm in the UK, so I'm going to vanguardinvestor.co.uk, which is our local Vanguard website. Once we get here, you go to what we offer and you can go to ETFs, or you can see the different investment accounts that you can open. But let's now go to ETFs, and here you will see the ETF browser. Let's close this quickly. So you will see certain criteria here. Okay, we're looking for ETFs, and now we're looking for the different criteria that we can choose from. Region, we're not going to select specific region. Risk level, we're going to leave it blank because we want to see everything that they have currently. Management type, this is very important here. You would want to go for the index, not active management type. And share class, accumulation versus income distributing. This essentially means that the index can reinvest the dividends. You can reinvest those, or you can get them paid to you with the distribution option. Now, I don't know what's the reason, but in Vanguard UK, we don't have option for accumulating. If I click here, you will see that we have almost, not almost, but entirely 0 options. So let's uncheck this and see what they offer. For the sake of this tutorial, let's look for the S&P 500 tracking index. And I'm going to click here to select that I want to see the past performance of the index as well. And I'm going to scroll down. So we have some ESG investment options here. We're looking for the S&P 500. For example, here you can get access to the FTSE 100 and FTSE 250, which are UK's blue chip companies in the FTSE 100 index and mid-cap companies in the FTSE 250. So if you want to invest locally in the UK indices, this is your way to do so. Scrolling a little bit down, you have different options, and now if you want to invest into the plain vanilla ETF following the S&P 500 index, you go to this option. Let's go to fund details and open and see what information we're given here. You have the title. This is the ticker symbol, which is very important, and we're going to see why in a bit. So this one is VUSA. You will see the market price, you'll see the number of stocks, ongoing charge, and risk level 6 out of 7. You will see some different information about the index, as well as past performance. Of course, you will need to see past performance based on a lump sum investment. If you've invested in a particular time window, this is actually very useful tool that you can use to see how much your investment could have become if you had some money invested before. In the price and performance category, you will see on the day change, 52-week high, all information that you can possibly need, and you will see price analysis, current 1 month, 3 month, 6 months, 12 and 18 months, essentially different periods. Now, you will see that you have market value and net asset value. The market value of the fund is essentially what you can buy and sell the fund for, and the net asset value is the total value of the assets held within the fund. In the case of ETFs, you will see very minimal difference between market value and net asset value. And the reason is that if the net asset value is higher, for example, than the market value, then it means that you can buy stocks on discount and everyone will jump and will drive the price up until the level of equilibrium. So essentially you might have some currency difference here, or you might have some slight difference between the market value and the net asset value, but essentially usually what you pay for is exactly what you get in terms of holdings within the ETF. I don't know what the reason is, but Vanguard don't have any other S&P 500 option apart from VUSA, VUSA, which is plain vanilla S&P 500 tracking ETF that is based on the London Stock Exchange and that is distributing dividends. So this is not dividend accumulating. If we, for example, go to the Trending 212 website, which is what I currently use, I do have my stocks and shares I sell with them. Okay, if you go to more menu and you go to trading instruments, you will be able to search for different instruments. Let's make some experiment and type S&P 500 and actually type Vanguard S&P 500. You will see that we have number of different Vanguard S&P 500 ETFs here. If we select exchange to be London Stock Exchange, you will see that we do have 4. And this is very confusing for some beginner investors because you don't know what the difference between all those is. And I'm going to tell you that now. We have VUSA, VUAA, VUSD, and VUAG. Okay, let's start with what we do have actually on the Vanguard website as well, which is VUSA, VUSA. It says it here, this is dividend distribution ETF that is priced in British pound sterling. If we continue, you will see that we have dividend distribution, again based on the London Stock Exchange, that is priced in US dollars. And then the other two options are dividend reinvesting, VUAG, priced in British pounds, and dividend reinvesting, VUAA, priced in US dollars. Now, if you like this video, you would want to watch this video next, where I explain how investment works and what are the products you can invest your money in. Essentially, it's a must for beginner investors. I wish you all the best and I will see you next time.